many of you would know, obviously, Geoff Summerhayes, Executive Member of the Australian Prudential Regulatory Authority, but also has a number of international roles which I think are particularly relevant for today's discussion. In terms of the Executive Committee of the International Association of Insurance Supervisors and Chair of its Audit and Risk Committee and Chair of the Sustainable Insurance Forum, which was established under the UN Environment Program, and also a past history in the private sector in insurance as well, which I'm sure it definitely doesn't inform any of your actions as a regulator. So, look, Geoff, I'm really keen to start with the international in terms of the discussion around what's happening with climate change as a financial risk, as an investment risk, and just really some of the interesting collaboration that we're seeing emerging through the international networks of different regulators as well. So I wonder if I could start by A, welcoming you to the stage, and B, also asking you to provide some insights on exactly what's going on with a lot of the international networks and the collaboration that we're seeing as well.
Well, thanks, Emma, and good afternoon, everybody. It's good to be here, and thank you for the invitation, Emma. I've enjoyed your program, and congratulations on what looks to be a terrific couple of days. So
thank you.
Nice to be part of it. A number of people this afternoon, panels I've enjoyed, have talked about the significant change in the last couple of years, and I think there's been an absolute paradigm shift for not only the investment community, but for the regulatory community. So why is that so? Well, going back 4 years, there were two very reliable internationally market signals which brought these risks forward. And the first of those was the Paris Agreement, signed onto by 200 countries. And the second, albeit a voluntary framework, was the Task Force on Financial Disclosures, TCFD, by the Financial Stability Task Force, Financial Stability Board, I should say, prompted by the G20, which also put out a very reliable signal. Now, here in Australia, we had a third, and that was the Hutley legal opinion. And so when you brought those together, there was a big shift of regulators who were struggling dealing with post-crisis reforms, which had gone on for about the best part of 10 years, capital liquidity, all these very important post-GFC issues. And so there has been a real awakening around this risk. So you now see the Network for Greening the Financial System, NGFS, which has 40 central bankers on it globally, including the Reserve Bank of Australia and the Reserve Bank of New Zealand. You see the forum that you referenced that I chair, the Sustainable Insurance Forum, which is the insurance equivalent of that, set up under the UN Environment Protocol. The Bank of International Settlements, which is the umbrella organisation for the Basel Committee on Banking, and the International Association of Insurance Supervisors, which are the global standard setters for both banking and insurance. Very interested in this topic. The Financial Stability Institute, another offshoot of the BIS, doing a lot of work in this area. So, and you can't go anywhere internationally within the regulatory community at the moment without there being climate being a very dominant issue. And I'll just give you an insurance reflection on that. Going back 2 years ago, when on the International Association of Insurance Supervisors, which I sit on the executive, it was very difficult to get a conversation up around climate and sustainability issues. We've just released a 4-year plan, from 2020 out to 24, and climate is one of 4 priority areas in the plan. And that would have been unthinkable 2 years ago. Yeah.
I mean, it's interesting, so many jurisdictions coming from so many different political, cultural, regulatory environments. I guess, how do some of those differences play out in those conversations, or do they? And where are some of the commonalities that you're seeing across the different sort of regulatory bodies?
Well, Europe is leading, and Europe has this whole agenda very integrated into political leadership, into the law, into regulatory action and community engagement on it. And there's something about Europe, I guess, being such a connected group of 300 million people, so they depend on each other. We see a lot in developing countries where it's a big issue, and it's a much more existential here and now threat for those countries, and that's about capacity building, options for risk transfer, for financing, where often those risk transfer mechanisms and finance are just not available because of climate or environmental risks. Asia, very much so. Japan, somebody referenced Mark Carney's speech last week in in Tokyo. I'm not sure whether that had anything to do with a certain sporting championship that was on in Japan at the moment. But Japan has really, JFSA has really stepped up on TCFD and embedding that into Japan, which is inherently a very conservative economy and a late adopter on some of these regulatory issues. And I would say, and then so the elephant in the room, the US, I know the US has shifted in the regulatory community from being opposed on these issues to being neutral on these issues in regulatory conversations. And we see that in insurance, and we also see it in the banking sector, although the Fed is still not a member of the NGFS.
Okay. One of the questions that I hear a lot from investors, whether it's the board or the investment committee, is this question of why is climate change different? Why is it a different type of financial risk that requires this more high-level response as a systemic issue? What makes it different to other types of financial or investment risks that finance sector should be dealing with?
So, well, it is and it isn't, I think is the short answer. It isn't different because regulators and indeed boards and management should think about the frameworks that currently exist for managing risk, and TCFD helpfully sets us out. What's your governance arrangement? What's your strategy, your risk management, your mitigants? How do you disclose? It is different, however, from other risks in that unlike a capital risk or a cyber risk, you can always recapitalise an organisation. In a cyber risk, you can recover the data. Nobody's yet worked out how to cool the planet. So climate is a ratcheting risk where it is ratcheting up. And 2 degrees was chosen because above 2 degrees there was a whole pile of feedback loops which nobody's quite sure on how these natural systems are going to play out. You referenced 3 degrees in your opening today. That's a very unpredictable world from a whole range of perspectives. And so it is a different risk because you can't recapitalise, you can't recover the data, like you can in those others. You can't cool the planet.
You think it's also a question of where it goes the other way, that if there is a sudden, in terms of the physical risk, but then the transition risk is if there is a sudden market correction or a repricing against that potential risk and dramatic action is taken, that's also necessarily being managed in terms of risk management approaches as well?
So I think the community, organisations, regulators, we would all like an orderly transition. Guy Debelle articulated this very well in his speech earlier in the year, which talked about the difference between cycle versus trend and identifying those differences, and that we'd all prefer an orderly transition. But history shows that society doesn't always have orderly transitions from one phase of the economy to the next. Think of the dot-com bubble in the early 2000s. The direction of travel was very clear, but the adjustment was very poor, at least as it related to an investment risk. And people are naturally worried about a carbon bubble. They're naturally worried about how organisations make the trade-off between buying now or paying later.
Okay. What about if we bring it back home again to the Australian response? What's your view of how the Australian investment community and finance sector is tracking in terms of benchmarked against some of the other jurisdictions as well? And in that context, and what do you see as the potential impact of some of the initiatives that are underway within the Australian market as well, such as the Sustainable Finance Roadmap?
Well, rooms like this would indicate that it's going quite well, but perhaps we're talking to the true believers in the room. And of course, the truth is that the community, there are a range of understandings and a level of engagement on the risk. APRA did earlier in the year a survey of our 38 largest super funds, banks and insurers, and we were actually very gratified by what that survey showed. In fact, it was a stocktake paper, an issues paper titled Awareness to Action, released on the 20th of March, if you want to have a look at it this year. And it was a very gratifying, because at least the largest firms have evolved a great deal in the last 2 years. Our major banks, our major investors, our insurers all have transitioned significantly. But APRA regulates 600 institutions, and the tail it's a little more patchy. ASFI was referenced today, the effort of the Australian Sustainable Finance Initiative, which has about 80 people actively involved in working groups across the whole financial sector, I think is a huge proof point. Organisations like yours, Emma, are doing terrific work. So I think we should feel good about where the traction that has occurred in recent years, but as it's been pointed out today, there's much more to do, and the area where the gaps are is around data, taxonomy, modelling. These are very complex things, and you can't make good decisions without good data.
Yeah, I mean, I wanted to get into a little bit in terms of our pockets of if you think about Australia versus other jurisdictions as well, areas of strength, areas of weakness relative to other markets and other jurisdictions. Where are probably the biggest opportunities where the Australian finance sector should really be stepping up and doing more?
Well, we are at one level an incredibly challenged economy and community. We are vast. 95% of the population live within 50 kilometres of the coast. We have a carbon-intensive economy. We are highly dependent on agriculture, and we're also one of the biggest natural catastrophe markets in the world. So on the surface, that looks problematic. But the flip side of that is that we are incredibly rich in the elements that will be part of the low-carbon future, low-carbon economy. So while we have an abundance of carbon resources, we have an abundance of rare metals and rare earths, which are, of course, vital to future technologies. We have an abundant supply of natural resources. We have huge amounts of land. There are technologies to turn air into water, which redefine how we think of arid land. So there's a huge opportunity for that to be grasped, and of course the finance sector is the enabler of that, whether that be providers of credit, insurance or investment.
And then on the other side, the challenges and the issues. I mean, you touched a little bit on issues of data, availability of data, the complexity of the analysis that's required. I mean, what do you see as some of the biggest issues in that area, and potential solutions that are coming through, at an economy-wide level as well?
Well, collaboration. So, no regulators, investor group on climate change, banks, insurers, and super funds, CSIRO, BOM, universities, consulting firms, rooms like this. We need to collectively work together to solve what is an inherently and analytically unbelievably complex issue, because we're dealing with natural systems, and how will those natural systems play out, and how will they go from a natural system evolution into a economic and impact on real assets and the real economy. So and the modelling of that is underdeveloped for a risk of the scale and existential nature that we're facing, and so that's where the collaboration and the linking needs to occur.
And is there further work that you're doing either through APRA or through the international networks as well, which is looking at some of those challenges?
We're trying to be, we don't hold ourselves out as experts on this in any shape. So what we're trying to do is regulators, both the Reserve Bank, APRA and ASIC, is trying to support those forums. So we are on the STEERCO as an observer member, along with ASIC, of the ASFI initiative. One of those streams, work stream 3, is about data and taxonomy. Likewise, at the NGFS, where the Reserve Bank is present, in fact, I think their work stream 3 as well is on the same issue. So I think the regulators are viewing their role as helping to be facilitators and giving a nudge to keep it moving along, because we recognise the significance of the risk, and supporting industry. In fact, the ASFI, we have a Council of Financial Regulators, which is made up of the Reserve Bank, APRA, ASIC and Treasury, and we meet to talk about specifically a working group on climate change risk, and we've got the ASFI streams of work presenting to the Council of Financial Regulators later this month.
And one of the other aspects of the data and analysis is what's coming through quite a lot in the TCFD and the work around scenario analysis is the forward-looking nature of the analysis and then the accompanying disclosure that companies and investors are also being asked to do. I mean, one of the questions that we hear quite often is the challenges of, traditionally we report historical performance data, and now we're moving to forward-looking analytical data. I mean, how do you see some of those challenges playing out in terms of the inherently forward-looking nature of climate risk in many ways as well, with insurance or investment?
I mean, it's unclear, so is the short answer, which I think goes to the need for better modelling and understanding natural systems and how they flow through to changes in economies, business models, economic impacts. So that is underdeveloped. But we should have the skills to solve it. So TCFD is a terrific framework for that, but the fourth leg of TCFD, which is around metrics, targets, scenario, taxonomy, TCFD is relatively high level, which is its great attraction because of simplicity. But there are other bodies that are helping to provide the scaffolding underneath that too, so that we can solve the modelling challenges.
And then what about, I guess, the opportunity side as well in terms of the structural shift we're likely to see, for example, in the Australian economy, but in global industry sectors as well? Do you think that we are sufficiently capitalising on some of those structural shifts or appropriately capitalising on the emerging investment opportunities of the transition as well? And how do we get better at doing that as well?
So there's a lot of focus on energy, and of course that is one of the big systems that has to transition, and my view is that the energy sector transition will play out a lot quicker than everybody thinks. I think that will have played out by 2030. The other big systems to change: transport, agriculture and property. And so Damien on the previous panel spoke about the opportunities in renewables. I suspect while there's much more to do, a lot of the low-hanging fruit has probably gone there. So what's going in the transport sector, what's happening around agriculture, changing property models. We're talking trillions of dollars of investment transition for decades to come. And people are going to get caught on that, and there are going to be organisations that also make an enormous amount of return from those transitions, as there has been with every structural change that's occurred with the economy.
I might ask a cheeky question and then possibly open it up to the room for questions as well. I know that you were here for the PIAT, the Perfect Storm Pension Fund Trustee Investment Committee discussion. As a regulator, and assuming they're a regulated entity, I mean, would you have any comments or thoughts around whether that's a fair reflection of the current state of play, advice for the trustees, advice with quotation marks around it, observations in terms of the tenor of the conversation happening at the board level for investors in Australia at the moment, based on your perspective from the regulatory side as well?
Well, I don't. The cop-out would be to say that I don't oversee the superannuation sector. My colleague Helen Rao does that, but that would be a cop-out. I did
say it was a cheeky question.
Yeah, no, and I'm happy to answer it. It's a good question. So I enjoyed the panel. I thought they were great. They were great sports, and unfortunately, there were elements of it which were probably very close to the truth. I mean, again. Not quite sure what the number is, I think perhaps 130 different RSCs that we regulate. And while there are some examples of very good practice, world-leading practice, and that's been called out in various surveys, both our super funds, our banks and our insurers, there are great standout examples that, but there is always a long tail, and that tail would represent a reflection of the community. So there'd be sections which we've had super funds going back not that long ago investing in infrastructure that had as a revenue stream carbon intensive assets which weren't asking those questions about modelling how a transition to a low carbon economy was going to go in the future. So what, as a regulator that's interested in safety and stability, all we want to make sure we're not taking a view one way or another. We're just taking a view on that the risks are appropriately managed and there is appropriate governance and oversight and metrics into those risks so that they can be managed into the future.
So it sounds like the PSS board made the right decision in putting in place a roadmap then.
I thought the way that panel evolved, which was very helpful. So, while, as I said, it was good fun, in the end, it looked at the more strategic issue instead of a lot of brochure sticker marketing about that we have a sustainability policy, which really, I think at the start of that panel, was not embedded into what they were doing. So APRA, I should just say, of the 38 major institutions we surveyed, and we've got a 100% response rate on that, we are now doing a deep dive over the next 12 months with each of those institutions, just understanding the layers of what they are doing around governance, strategy, risk management, and metrics and targets, and we'll play that back as a thematic review later next year, I suspect.
Okay, great. All right, I am looking to now open it up for questions. If you do have a question, please put your hand up. We've got one here, and one down here, so we might start here and then double back this way.
Start here?
Yes. Yep.
Mark from Oswald. Thanks, Geoff, that was great. You expressed confidence in the energy sector, electricity making the transition between now and 2030. When you've got what is currently a very popular federal government that seems determined not to facilitate an investment framework that will help, and seems determined not to help us create signals via a carbon price or otherwise. When you have that determination there, why is it that you're so confident?
Mark, I should say right at the outset, I'm no expert on energy. So, and what I would say to you, I love the Bill Gates quote that we often overestimate change in a 2-year time horizon, but we completely underestimate it in a 10-year time horizon. So what my view on energy is that wherever you get convergence of different technologies together, so batteries, EV, photovoltaic cells, other sources of renewables, and you get computing, and the cost curve is going so down that the economics will drive it, and the S-curve of adoption on all these things gets steeper and steeper. So, we think about the devices that everyone's got in their lap and on their tables. Were invented 12 years ago, where those things came together, and 12 years later, it's inconceivable that how could life operate without a mobile phone. 2007, the mobile phone, and there was saturation within under 10 years on that, and it happened because of the convergence of technology. It happened because of the S-curve of adoption, and it happened because the cost curve just plummeted, and we will see that in the energy sector, is my view.
We have another question here. We'll start with there and then we'll come back here. Sorry.
We can go for the other one if you want. I always answer.
Wait, you've got the microphone, go.
All right, cool.
You've got the conch.
Cool, awesome. So I just wanted to ask you, Geoff, about whether or not our risk management currently is happening across the required breadth that we need. And what I mean by this is that we're presently all getting better at TCFD. We're not there yet, but we're getting better. We're doing quite well at doing our risk thinking in listed markets, where we've got good disclosure, but we are also seeing a few of us have observed a flight of assets into the unlisted space where they're not as observable. And also a lot of this risk will be borne ultimately by states. And so my question is, do we need to start thinking about risk observance and regulation in the unlisted space and also at the sovereign level?
Hi Zoe, thank you for the question. You never ask easy questions, do you? Regulators globally are reluctant to be overly prescriptive at this stage, and that is because this is a developing discipline and a developing capability. So we are I think the desire is to keep things at a principles level, because if we were more prescriptive in what we were looking for within terms of taking risk management, we are likely to look back on that in a couple of years and say that was the wrong call. So TCFD is a great first base, and what we would like to see is globally, we'd like to see a far greater take-up of that. And while a lot is made of TCFD, 8 trillion of assets, 800 companies globally, major companies signed on, that's a fraction of the 88 trillion of global assets that there is. And it's gratifying the progress in the last 2 years. But again, there's an enormous amount to do. In terms of the unlisted area, well, again, there would be a lot of APRA-regulated entities, some of whom would be in this room, who would be investing in unlisted assets, and I think the obligation still is on those entities to make sure that they are comfortable with the practice and the disciplines that exist in where the look-through is. I don't think you can't say that just because it's beyond the regulatory perimeter, therefore it's not an issue. And finally, Zoe, that this change is not going to be driven by any one group of stakeholders. It's going to be driven by the weight of money, which I think is incredibly powerful. It's going to be driven by community groups, by customers, by regulators, by governments, by associations and thought leadership groups like IGCC. So there is, it's almost, I suspect there'll be nowhere to hide.
Mm-hmm. Yep, here, and then back to another question here.
Hi, Geoff. My name is Tony Zhang, and my question regarding the Basel Committee. So you mentioned it earlier. So recently, for some work, I talked to quite a few developing countries, their banking regulators, for some development bank work. And so one thing they're proposing, some kind of propose to change the Basel capital requirements to have different requirements for green investment or climate change investment. Do you have any comments on that?
That is a hot debate, Capital. And so my answer would be that if your risk framework was appropriate, you would already have an adjustment for that in your credit risk modelling or in your insurance pricing. So if you understood the risk, you would be pricing the risk, and whatever the credit rate weighting you put on that, or indeed the insurance risk premium you put on that, you'd have the appropriate capital to support that. So the question is there a Pillar 2 adjustment that might come to certain organisations, or is there a Pillar 1 adjustment in the capital ratings? There are some numbers being bandied around which are good for the conversation, but I think we're a way away from that analysis. And again, it's a bit like my answer to Zoe. If we were to be overly prescriptive, there is a risk of making the wrong decision at this point.
And last question just here at the very front. Thank you for the cooperation of the audience.
Thank you so much. Can I start by acknowledging the incredible work that you personally have done and how grateful I think the whole room is for it. A number of years ago, IGCC led a number of workshops on what it is like to invest in a 4-degree future. And I commend those reports to you because I think it elevates our sense of risk and helps to provide that lens of why the existential feeling is out there in the community within lots of professionals, not just those on the street. I guess taking this very respectable conversation, and it is so exciting to see the engagement, but acknowledging that our emissions are rising and that there doesn't seem to be a sense of ambition. In fact, there seems to be the reverse in terms of that pathway. We see BHP taking strong global leadership on Scope 3 emissions and recognizing that their business is at risk by virtue of their product being used offshore. So my question is, and obviously it's not just an APRA question, it's a sort of regulatory existential question. At what level do Australian regulators recognize that our exports also are putting our economy at risk?
Another easy question for you there, Geoff.
So, well, thank you for your question and your comments. So, I'll flip it around a little bit and say that I think the essence of what you were saying is that we are having very polite conversations about this issue. And as a community, we should be having more forthright conversations about it, the issue. So I absolutely agree with that point. So what are some of the more forthright questions? There is a lot of talk about 2 degrees. In fact, the Paris commitments were 2.7 degrees. We are currently on a pathway for somewhere well in excess of that, for 3 degrees without some significant change. And so you talked about scenarios 4 degrees. The chair and CEO of AXA said 12 months ago that a 4-degree world was uninsurable. Now, if a 4-degree world is uninsurable because of the unpredictable nature of that, then you won't be able to extend credit. And so, you know, what does that mean? What does a hothouse world mean? So, yeah, I think there's a balance here between hope and fear. And so climate is a communication challenge. It's, somebody said earlier today, a change management challenge. But you've got to do that with good data, and you've got to do that with good information, and you've got to engage people in the broader community. So I would advocate that we have more forthright, open conversations, but we take people with us on that journey, because the transition to a low carbon future will have impacts that will not be even across the economy. Some parts of the economy will be much harder hit than others, and as a society we need to think about how we look after those sections of society that will be very adversely affected, so that the majority of the society can transition to this low carbon future. So it's like any other structural adjustment, and I think we do that with better data, better engagement and more honest conversations.
Right. I'm afraid, I know there are people who would like to ask more questions, but I'm afraid we are going to have to wrap it up there. Please join me in thanking Geoff for that fantastic conversation. Thank you. Thanks very much.